type which you will be tested at the exam, which is known as income receivable. And I would like to show some ledger accounts and general journal entries, which is an extension of the previous adjustment, that is accrued expenses. Okay, we'll move on to that. If you can remember, these are the general journals and the ledger accounts. Here are the general journals and these are the ledger accounts, which are relevant for the activity 1 in your textbook. So there I have showed you the double entry of accrued expenses. The relevant expense account you have to debit and accrued expense account you have to credit. So here, according to the example given in your textbook, with regard to the rent expense, accrued rent expense, in the general journal, this is how we are going to show the journal entries. So 31st December 2019, the rent expense account will be debited by 20,000 because that is the amount which is accrued, and accrued rent expense account, that is the new account that we are going to open up. Accrued rent expense account will be credited 20,000. And normally in general journal, unlike the other prime entry books, we are supposed to write, we have to quote what this is. So then in this double entry, we are going to show the accounting for accrued rent expense of 20,000. So keep in mind, only for the accrued amount we will be writing the journal entry. So in parallel to this, in the ledger accounts, in the rent expense account, already on 31st December 2019, there's a balance, or you can say in terms of cash, there's a brought forward balance of 40,000, which you have been already paid with regard to rent expense. This is the way of adjusting the new entry, which I have showed in red color. The debit entry, rent expense account debit 20,000 and accrued rent expense account credit 20,000. We had to open up a new accrued rent account and we are going to credit it. So why we are debiting this account is, the expense account is, expenses becoming more. So therefore we are debiting more. Why we are crediting a new account called accrued rent account is, it's a current liability of the business until you are settled. So that will be credited. So thereby, these are the two entries. This is the way we are recording them in the ledger account. So at the end of the period, what we are doing is, when you balance off the rent expense account, you will end up with a 60,000 credit balance, carried down balance in the rent expense account. That should be transferred to profit or loss statement. The whole 60,000 must be transferred to profit or loss statement under the expenses. That is directly under the administrative expenses. Rent expense 60,000 will be debited. The whole amount will be debited, not only the 20,000 which is accrued. The total account balance will be transferred. Then this accrued rent account 20,000 credit balance will be taken to the statement of financial position as a current liability. Under current liabilities, accrued rent expense will be shown as an item of 20,000 rupees. So these two are the extracts of profit or loss statement and the statement of financial position. And I hope you all are clear with the way of writing the journal entry, then the way you are recording them in the ledger accounts, and the way you are going to record them in the two financial statements. Then this is the second double entry or the journal entry shows there's a 3,000. This is different from the previous example. So electricity expense account debit 3,000 and accrued electricity expense credit 3,000. Then in the telephone expense account, the third example also, the full amount is accrued. Telephone, in both cases, telephone expense account, full telephone expense have not been paid during the period. I mean, the whole amount is accrued. Therefore, we are going to open up a new account called telephone expense, and debiting here, we are going to open up a new expense account called electricity expense account, and we are debiting the full amount. And crediting here the relevant accrued electricity expense account and here accrued telephone expense account, two new accounts. And the double entry will be shown like that, and the ledger accounts will be like this. They are at the beginning, there's no brought forward balance or a cash balance. Newly on 31st December 2019, we are going to record the full accrued amount, accrued telephone account 3,000, and it is debit, and here accrued telephone account credit by another 3,000. So at the end of the period, again at the telephone expense account, the total will be a balance of 3,000, which we are going to transfer to the profit or loss statement, and that will be shown under expenses. Again, it comes under administrative expenses. In the profit or loss statement, the full amount will be accrued, and the accrued telephone account, once you balance the account, there will be a credit balance brought forward or carried forward of 3,000. That will be shown under the current liabilities as accrued telephone expenses. So I hope the way that we are going to do it in the general journal, I mean the adjustment will be first recorded in the prime entry book called general journal, and then we will be posting it to the ledger account, and the full amount will be transferred to the profit or loss statement under the accrued concept or the accrual concept which we have learned, and the statement of financial position also we will be shown only the amount which we have not paid or not settled. Accrued amount only comes in the statement of financial position. Okay, with that in mind, today I'm going to pay your attention towards the second adjustment type, which is known as income receivable. As I explained to you in my previous videos, we will be learning five major types of adjustments. So we are doing all these adjustments based on the accrual concept. Under the accounting concept of accrual concept, simply if I am going to remind you it again, irrespective of whether you have received an income during the period which is relevant for the period, or whether you have paid or not the expenses which is relevant for the period, when you are preparing the financial statements, namely the profit or loss statement and the statement of financial position, you have to consider all the incomes and expense balances which is relevant for the accounting period. So under that in mind, we have learned the first type of adjustment, which is known as accrued expense, and this is the second type of adjustment which you are going to learn, income receivable. Once in a way, this can be also called as accrued income too. In the previous case, expenses which we must pay for the outside parties have not been paid, and here incomes which the business organization is supposed to receive has not been received during the period, and we are going to do an adjustment for that. Okay, let's see what it means. Income receivable are the income receivable within the accounting period but has not been received yet at the end of the accounting period. These are also known as the accrued income. I think it's clear to you. These are the incomes which we are supposed to receive during the accounting period, but we have not received yet. So therefore, we are going to account for them during the accounting period as we have received it already. So this income receivable is considered as a current asset. These are the incomes, like as examples I can give you rent income or the interest income to be received on behalf of a fixed deposit or a savings account, or the dividends with regard to the shares that you have invested in the stock market. So if they have not been received before the end of the accounting period, until you are receiving them, we have to consider them as current assets because they are the inflows to the business. Okay, so therefore we will be treating them as current assets, and it will be adjusted in the general journal as we have adjusted the accrued expense also in the general journal. All the adjustments must be recorded first in the prime entry book called general journal. So here also we are using the same journal or the prime entry book. So here the double entry, when we are looking from the accounting point of view, double entry of income receivable will be the relevant income receivable account debit, because it's an account to be received. Income receivable, relevant income receivable account debit and relevant income account credit. So if why income receivable account is a debit? It's a current asset. So in future we are going to receive it. So we are supposed to debit it, and we are going to debit it. The relevant normal income accounts are credit balances, and we are going to credit the relevant income account. We'll move on to the next slide. Okay, here I have quote again activity 2 in grade 11 textbook, and I like to proceed with this activity, and thereby I hope you will get a better understanding or knowledge with regard to this second adjustment type. So it says the financial year of Dilhara Enterprises ends on 31st December 2019. Let's hope. So the financial year of Dilhara goes up to end of 31st December 2019. Then number 1, a shop has been rented for 6,000 per month from 1st January 2019. Rent income relevant to only 8 months has been received in cash. Second one, money of the business has been deposited to open a fixed deposit for 50,000 on 5th 2019. Interest income of 4,000 rupees has been received, while 2,000 rupees is to be received relevant to this fixed deposit. Then number 3, only 6,000 rupees has been received out of the 8,000 rupees of dividend income receivable. Fourth one, sales commission income of 4,000 rupees is to be received as a result of selling goods owned by another enterprise. So these also shows 4 types or 4 ways that you can be tested at the exam with regard to this second type of adjustment, which is known as income receivable. So according to that, the accounting period of this business also 12 months. As they said, the final date will be 31st December 2019. When you work out 12 months backwards, 1st of January 2019 will be the starting date of the accounting period, and this is the closing date or the end date. So thereby 12 months they are in between. So here the first one says a shop has been rented for 6,000 per month. So normally for a month there will be 12 months, and here they have received the rent income only for 8 months. So accordingly, rent income received in cash already is 48,000, and rent income to be received is 24,000, which is for 4 more months, which they have not been received. So thereby the rent income relevant for the period, or the total rent income, will be 72,000 rupees. In the second one, money of the business has been deposited to open a fixed deposit of 50,000 on 1st 5th 2019. So that is, you can't calculate the interest for the whole year because they have not started the deposit, opened up the deposit on 1st January 2019. It's on 1st 5th. After 4 months only, they have been started the fixed deposit. So therefore, we have to account for 8 months. The interest income must be, or the fixed deposit interest income must be calculated only for 8 months, and only that 8 months is relevant for our accounting period. So from that, interest income of 4,000 has been received, while 2,000 is to be received relevant to this fixed deposit. So thereby here, the amount relevant for the period is 6,000. Income already received is 4,000. So therefore, income to be received or income receivable will be another 2,000 more. So thereby the total amount relevant for the period, the total income relevant for the period will be 6,000 rupees. This income will be credited, rent income will be credited to the profit or loss. The total income of 6,000 also will be credited to the profit or loss. Okay, then when it comes to the third one, only 6,000 has been received out of the 8,000 of dividend income receivable. So again, total dividend income relevant for the period is 8,000. Out of that, 6,000 already they have been received in terms of cash, and in dividend income to be received is another 2,000. So 8,000 rupees is the total amount or the dividend income relevant for the period. Then the fourth one, sales commission income of 4,000 is to be received as a result of selling goods owned by another enterprise. That means the whole income, commission income of 4,000 has not been received by the business. So therefore, the total amount 4,000 will be the income to be received relevant for the period, which has to be transferred to the profit or loss. So for these 4 examples, this is how we are going to record the general journal entries in the general journal. To mind you, here also you have to use the full format of the general journal. And on the last date of the accounting period, we are going to do the adjustment. And the rent income receivable debit. Under the rent income receivable will be debited only by 24,000, which is to be received amount. Only the amount to be received will be recorded, and the relevant income or the rent income account will be credited by another 24,000. So why we are debiting the rent income receivable? Because it's a current asset. Therefore, asset accounts are debit balances. So we are debiting it. That is the new type of account we are going to open up under this adjustment rent income receivable, and the relevant income account will be credited 24,000 because incomes are credit balances. Then under the second example, interest income receivable debit 2,000, interest income account credit 2,000. In all these cases, don't forget to write the narration for each double entry. Then third one, under dividend income receivable account debit 2,000 and dividend income account credit 2,000. With regard to sales commission, the total amount they have not been received. So therefore, the total amount we are going to put the double entry. Sales commission income received 4,000. Sales commission income account credit 4,000 rupees. So these are the ways that we are going to record the entries in the relevant ledger account. So rent income account, already a balance brought forward or a cash, they have been received in form of cash 48,000, which is relevant for the period, and we are going to record the income to be received, or you can use the word accrued income also. 24,000 we are crediting and debiting the same amount under the new account called rent income to be received or accrued rent income account. So at the end of the period, the full amount 72,000, once you balance the account, 72,000 of debit balance will be debited here. That balance will be credited in the profit or loss statement under other incomes. The whole amount, the total amount must be considered under the accrual concept. So then this 24,000 will be a balance brought forward of or carried forward of 24,000, a debit balance that must be shown under current assets. So this is an example where you have received half of the income or 8 months income and 4 months income has been not received. But in this case, under the sales commission example, the whole amount has not been received. So we are newly going to keep an account for that. So we are opening up a new account called sales commission income account, which we are crediting and the full amount to be received 4,000 and debiting sales commission income to be received account or accrued sales commission income account. So thereby this, after balancing the account, the total 4,000 will be shown under the profit or loss statement under other incomes, and the debit balance of sales commission income to be received will be shown under current assets. Sales commission income to be received 4,000. So this is how we are going to calculate the relevant figures, and this is the accounting part. Starts from here. First we are going to record it in the general journal. Then we will be recording them in the relevant ledger accounts, and then we have to extract them to the profit or loss statement and the statement of financial position, which is known as the two financial statements of us. So that is the end of the second type of adjustment, income receivable. And I hope to see you in my next video with the introduction of the third type of adjustment, bad debts. Bad debts, the third type of adjustment. So far we have completed two adjustments. The first one is accrued expense adjustment, and this is the second one. Today I explained income receivable. Okay, hope you all have gained some knowledge out of this, and I hope to see you in my next video with a third adjustment. Until then, goodbye. Thank you.